Hey everyone, welcome to today's video, and today we're going to talk about Tesla stock. You know that over 8 months ago I made a video where I said essentially that Tesla stock was very cheap and it would be a great investing opportunity. Since then the stock has skyrocketed. We can see that it's up around 150% since I made that video. So it's been a great opportunity for Tesla stock. But the question is, if you look at Tesla stock back in 2022, when they had these insane gross margins for their automotive business. Let's look at the chart on the left for a moment. We can see here, zoom in a little bit. So back then they had around 27% gross margin for their automotive business, purely like not energy business, just automotive sales, so car sales. And that was great. But I think a lot of Tesla bulls, including myself, we were quite a bit unrealistic because we never saw that, drop in automotive gross margin so severely to, let's say, low 10s from like high 20s. And that affected the stock price, obviously. What's happening since then is that the gross margin on the automotive business is slowly but surely recovering. Although that has to be said, I'm not quite sure if we are gonna ever go back to normalize these kind of levels. Automotive is a very competitive business, and even if the competition will not come from the legacy like Mercedes, BMW, Ford, and so on, the Chinese car companies will definitely for sure be there. So maybe it's unrealistic to expect the auto gross margin to go back up to these levels. Maybe one quarter it could be possible or two, but over the long term, I don't think so. But maybe currently we are sitting, remember Q3 is the last supported, so the last two bars to the right, these two bars here, or let's say four bars, they are future projections for Q4 this year and Q4 next year. I think we will definitely see a recovery still in the gross margin for automotive. Now let's go to the energy sales. That's one is really interesting. You can see that's a complete different picture. So the energy sales, although also lost a lot of gross margin back in 2022, it's now clearly going to different place and currently sitting at around, I think, 30% gross margin with projections for next quarter above 30% and maybe Q4 of next year just below 40%. That's obviously a complete different, let's say, business opportunity. Although the revenue basis won't be as high as the automotive revenue for quite a while, is there a realistic opportunity that the energy storage, so battery energy storage, will be tens of billions in 2030? I think that's possible, but we have to also consider that the battery electric storage business is gonna be crowded. There's a lot of players. It's BYD, it's Tesla, it's Sangro, and it's a lot of also other companies that people are not aware of. For example, there's a company called Canadian Solar, and those guys already have 5 to 10 gigawatt capability. That is, I think 25% of what Tesla can do right now. So there's a lot of competition even from smaller players. So one argument could be, are we bulls now making the same mistake that we did back in 2022 for the auto business, where we assumed that Tesla was a very special case and they would never have lower business gross margin than 20%? Are we making that same mistake for the battery energy storage business? I think it's possible. Remember, the battery energy storage, you're essentially purchasing battery cells from CATL, LG Chem, and the others, and you could say that then you package these batteries into a small package and add to it some inverters and some small electrical stuff, and you sell it for thousands and thousands of US dollars. I think the threshold to entry for that market is lower than the automotive business in itself, which means that long term I do not expect these gross margins to be this good. Maybe in the short term, the up and coming 2 years, that's possible, but not in the long term. I don't think so. In the long term, difficult to say where the gross margin should be realistic, but maybe 20%. That would be a good place to be. Still great, because that they are really increasing their battery energy storage business. Actually, if we go back to the numbers again, you can see that if you look at, well, let's have a look at the graph instead. Here you can see in the blue the energy sales, and it's been clearly going to different place in the last 1 year or so, where we had I think in Q4 in Q2 of 2022 they had a record year. In Q3 slightly less, but I think we are projecting that by Q4 of next year, they will definitely have an insane kind of growth. In fact, I think if we now go to the numbers and see, my projection says that for Q4 of next year, the revenue of for solar and battery storage, most of that revenue is from batteries and not solar, 5.5 billion US dollar. That's a 70% increase year on year. You can see that this 70% is compared to Q4 of my expected Q4 of this year. And that 70% increase will come with around 59% increase in cost of revenue, so cost of sales, which means as they grow their business, very naturally, they'll increase their margin as well. So that's great to see. Now, if you then try to summarize the video, so we looked at the tip ranks, the forecast, and you know that the analysts always increase their price targets finally when the stock is already up. No, most of these guys never gave their price target of 400 and 500 when the stock was, when I was making, or like amateurs like me and others on YouTube were making videos 8 months ago about the stock. But now when the stock is at 450, now these people, so-called experts, are trying to say, oh, we increase our price target. And you should never listen to them because they're always late to the game. In fact, you could say it's quite much more dangerous now to invest in Tesla stock right now than it was 8 months ago. And I think we have to be honest with ourselves. If you look at the numbers, I've still considered that for production next year, if we go to the graph, it may be easier to see. So here you can see my expectations of deliveries. So deliveries, I'm expecting 630,000 for Q4 of next year. That's quite substantially higher and up than the last quarter that we had, which was Q3 at 463,000. That's, I don't know, probably a 30% or so increase compared to the latest quarter, which was very, very close to the best all-time high, essentially. I think there was only 2 quarters, Q4 of last year and Q2 of last year, where they had slightly higher deliveries. But we in last quarter, we were very much up there with the best quarters in terms of deliveries. And I'm still, expecting 630,000 deliveries next year in Q4. So I'm bullish on the numbers in terms of deliveries. And you can see that if you actually then go what that means for revenue, that would be our automotive revenue of around 24.5 to 25 billion US dollar. And that would be a 18% increase compared to Q4 of this year with my expected numbers. Now, you can see that the automotive revenue increase will be slightly less than the automotive delivery increase. And that difference is based on that the average sales price. So as they increase the volumes, I think the sales price will continue in this trend that we have seen, starting in Q1 of 2022 at 50,000, 53,000, but slowly but surely going to the 40s, the high 40s, low 40s. So I think it will go down a little bit, but not by much. The slow will, the reduction in sales price will go down more and more. But I think, that's realistic to expect that maybe we have a total revenue for Q4 of next year at 35 billion US dollar to 35.5 billion US dollar if they manage to sell 630,000 cars. Is it possible that increased that sales number to, I don't know, closer to 700? I think so. But that would mean, I don't know, like 10% or so more in revenue. So a couple of billion or so more in revenue, maybe 3 billion in revenue more. But all in all, I think we are in the mid-30s in number of billions in revenue. And that would mean that if you then look at the cost of the revenue, I think Tesla is very lean. For example, if you look at the automotive sales, they will increase in my projections by 16.5% in cost of revenue. So it's substantially lower than the actual revenue, which was growing at 18%. So there's 1.5% difference there. So that's great to see. They are very lean. And you look at the operating expenses, their R&D sitting at around 1,128 million or so by this time next year, which you can compare to, for example, NIO, right? I've been covering NIO over the past year. NIO's R&D is sitting around 450 million for a company that sells 5 to 6 to possibly 10 times less cars by this time next year. Depends on how well these two companies perform. So Tesla is essentially spending a little bit more than twice the money on R&D, but selling like 5 to 8 times more cars. Same for SG&A. Tesla is a very lean again, 1.4 billion maybe by this time next year, which is, I would say, a little bit higher than, yeah, let's say Q4 of this year, which is expected closer to 1.2 billion. But Tesla again will sell, I don't know, 600, 700,000 cars Q4 next year, whereas NIO is maybe selling potentially 40 to 50,000 cars this time next year. But they are then, spending closer to 600 to 700 million on SG&A. So again, Tesla is 3 to 4 times more lean than NIO, both in R&D and SG&A. That's telling a great picture for Tesla, not so great for NIO, to be honest. Then looking at the net income, when it comes to Tesla, I think that the net income will most likely be to the extent of maybe 2x the level of the last reported earnings, a little bit more maybe, and a little bit less than expected earnings for this Q4. So in this Q4, I'm expecting 3.3 billion in net income. Q4 of next year, 5.3, maybe 5.5. So that's still great numbers, but that all works out to, let's say, GAAP earnings per share of around 1.6.6 or 1.5 US dollar. Now, if you take that 1.5 US dollar earnings per share, and let's say that, Q3 of next year is also almost as good, that's around 3 US dollar of earnings per share in the second half of next year. And let's say they manage to do a little bit less in the first 2 quarters. So let's say 3 US dollar of earnings per share for the second half and 2 for the first half. That's around 5 US dollar of earnings per share. Let's say they break my expectations and they come in at 6, which is 25% higher than my expectations. At 6 US dollar, the current stock price sitting at 437, I think. So if you take 437 divided by 6, that's our 73 or so times price to earnings ratio at the price you are buying now. I think they are, I think there's better options out there currently. For example, like in the semiconductor space, AMD or Micron. I think I would find those companies at the current prices much more realistic. Obviously, I'm not, against Tesla. Obviously, you see here, I made a video 8 months ago when the value was great. At the time, I was believing that it was a great value, but right now I think it's a little bit more difficult to see the valuation. A lot of people talking about FSD, but we have to be honest, FSD, it's gonna take a while. I by no means think that next year they're gonna take in billions in profit next year for FSD or even the year after that. So when you consider that FSD is still quite a while away, I definitely think Tesla is a leader in that market, but it's gonna take a while. So if you remove FSD, then it all comes down to essentially the automotive sales and the energy business. Potentially the robotics. Now the robotics could be a huge catalyst, if the robotics is anywhere near what we are possibly thinking about, it could, 5x this company with the amount of stuff that it's gonna improve for humanity. But currently it's still, far away, and I don't think the stock market will price that in before we see somewhat of a realistic pathway. So currently, energy business, the automotive business is all it's down to, and at the current stock price, I think it's a little bit too expensive. Still could easily run. Remember that Tesla has been this way, and it just broke the all-time high. Could easily run to 550 to even 600, which would represent, I don't know, like 30% higher at this current rate. But still, I think the risk that would come with that, with the stock price at 600 US dollar, it would be more than 100 price to earnings ratio for next year. And even if they miss somewhat in some of my expectations, which are, again, I don't think a lot of people are expecting Tesla to sell more than 600,000 Q4 of next year. That's quite a lot of deliveries. But even if they beat, I think still, it's not going to affect the price to earnings ratio that much. So yeah, I think it's not necessarily a bad investment at this stage, but I think the train has left the station for the moment. Even at 300, it makes much more sense because this is still a very substantial company. They are very lean and they could easily innovate at the rate that a lot of the smaller companies won't kind of manage to do. So I don't think this is a bad investment. But currently, I would say be a little bit cautious. Maybe try to see if the stock cools down a little bit. Still, it's up 150% over the past 6 months, right? So it's realistic that we could see a little bit of drop down, especially if the rest of the market takes a little bit of a breather. So yeah, that's gonna probably do it for today. Please like and subscribe, engage in the comment section, and see you in the next one.